Welcome to your last trainee video on the ACCA F8 Audit and Assurance paper. This video is going to deal with going concern and corporate governance. Going concern, this shall be fairly familiar to you because it appeared during your accounting studies also as being one of the fundamental assumptions underlying the preparation of general purpose financial statements. So you know that usually financial statements are prepared on a going concern basis. Appropriate application of this assumption is vital to the financial statements want to give a true and fair view. However, you know that in the current economic climate, many businesses are failing on a daily basis. So it might be a critical and topical issue from exam point of view. Please bear that in mind. Examination questions in this area usually have an element relating to audit reporting, so you must read it to the report issued by the auditor, and a going concern qualification for the auditor is perhaps one of the most difficult to give because there's a danger of assessing, or it's very difficult to assess whether a business is going concern or not for the auditor. Usually, again, this is a topic where the examiner has expressed his disappointment related to the candidate's answers. Going concern consideration may also apply when dealing with questions relating to audit risk and subsequent events, because such subsequent events, as we discussed in the previous video, may give birth to going concern issues and audit risks as well, similarly. So what is going concern as a key concept is basically it's based on the assumption that the business will continue to exist and he will sustain a viable commercial entity for the foreseeable future without the need to have a significant cutback at its present level of activity. So basically it will go on as it was going on in the past, because the statement of a financial position and statement of comprehensive income do present us an image from the past. What we want to know that the company is going to continue its activities on the same level in the future also. That means there's no significant cutback. So the readers of the financial statements will know that they should not expect a significant cut down on the operations. What is a foreseeable future? That's usually a minimum of 12 months from the current accounting date or from the reporting date. If for any reason the management would consider that it has to reduce this period, then this has to be disclosed in the notes to the financial statements, indicating obviously why the management chose to reduce that period. Audit approach. The auditor has to be always alert to indicators of going concern problems. Throughout the whole audit engagement, he has to watch out whether business risks are identified that would lead to going concern issues of the client. And in terms of business risk, the auditor has to identify its three components: operational, financial, and compliance risks, as we discussed it in the audit risk chapter. Obviously, it is important that when the auditor identifies such risks, he also seeks whether the client has undertaken some kind of mitigating actions against those risks, and whether the going concern is still a problem or not for the client, because if he had undertaken some mitigating factors or actions, then the going concern problem is still not there. So for example, for operational issues, a shortage of essential raw materials, for example, paper or woods, can be a problem, but if research and development department is close to find a synthetic alternative for woods, for example, in the furniture manufacturing environment, then that operational issue is solved. Or if the company had encountered massive forex losses, you would say that there is a financial risk that the company is facing, but if they're already implementing a new hedging policy, then it might happen that there's again no concern about that. Or similarly with compliance risk, if they had similar numerous fines or breaches of regulations, if they are implementing a new manufacturing facility that is more environmentally friendly, then that is going to mitigate the risks identified. What kind of procedures could the auditor undertake in such situations? Well, he has to assess the current and projected economic environment to see whether how is the economic environment, whether the company's development is sustainable in the future. Has to see also the industry sector in which the company operates. How are the competitors doing? How is the competitors developing, and what's their impact on the company's operations? They can review the correspondence files and board minutes for evidence of significant disputes, for example, with regulators or financial institutions. They can review subsequent period cash flow and profit forecasts. So whatever happened after the year end or the end of the reporting period, they can review it and assess the content and discuss obviously with the management procedures against any kind of risky activities or risky areas identified, as we exemplified up there, and obtain also management representations that, for example, they are going to implement that new hedging policy. What's happening with the audit report when we are discussing about going concern? There are several scenarios. If the going concern basis is used as is considered appropriate with no significant related uncertainty, there is no implication on the report. However, if the going concern basis is used by the client, but the appropriateness is dependent upon some significant uncertainties in the future, but that is fully disclosed in the notes, for example, then the report can remain unqualified, but the auditor usually uses an emphasis of matter paragraph to draw the attention of the users of the financial statements that there is a significant uncertainty in the future. However, if such significant uncertainty is not disclosed or is inadequately disclosed by the entity, then this probably will lead to an adverse opinion issued by the auditor. If going concern basis is used but it's not appropriate from the auditor's point of view, that is similar, it will lead to an adverse opinion because it's a disagreement with the management. If the going concern basis is inappropriate but financial statements are prepared on acceptable alternative basis that is adequately disclosed, then probably it will again lead to an unqualified opinion with an emphasis of matter paragraph. So probably the client issued its financial statements or prepared the financial statements on a breakup basis and it disclosed properly. Now, in terms of corporate governance, this is something that you already have come across at least in your law paper, and it is not the last time that you see this topic. It will come up also at least in paper P1, governance, risk and ethics. It's basically lying. It's a kind of 40% of your corporate governance paper. It's paper P1, so it's not very likely to be tested, but should not rule out because you should not rule it out because it might come up in a practical scenario question as part of, for example, a good internal control policy question. It might come up. So nowadays, obviously, it's a very topical issue, and you can read about important issues in the financial press. You should be aware that corporate governance frameworks were developed by many countries, and these frameworks can be rules-based, like the Sarbanes-Oxley Act in the United States, or can be principles-based, like the Combined Code in the UK. The principles-based and the rules-based approaches are already known to you, also from the, for example, the IFAX Code of Ethics, that's also principles-based, or the IFRS, that's also principles-based built up. Let's see what you have to know. What is corporate governance? Basically, I'd like a shorter version of the definition. That would be how the organizations are directed and controlled. Yeah, this is the Cadbury report's definition. In terms of the OECD, that's a longer definition. It's the relationship between the company's directors, shareholders, and other stakeholders. And it's also structure through which the objectives of the companies are set and means of achieving those objectives. So it's basically just how it's directed and controlled, set in few words. Features of the effective corporate governance. This shall be already known to you, but I'll repeat it just in short. You know that a board of a company shall be composed by a good balance of executive and non-executive independent directors. The chairman has to be independent. She shall not be considered a non-executive director. Also related to the chairman, he should be shouldn't be the same person as the CEO. They shall be different. The board committees. The board must form up some committees that will have different tasks. For example, the audit committee that has to be formed only by non-executive directors. Likewise, the remuneration committee. These are independent committees. The remuneration committee sets the remuneration of the executives, while the audit committee, we know, is overseeing the internal audit department and the internal control of the company, and also is in charge with reviewing the financial statements, liaising with the external auditors, and so far and so on. Appointments committee, this has to be a majority non-executives, likewise the risk committee if exists, otherwise it's combined usually with the audit committee. Directors and the board should be part of an effective induction program, and after that their knowledge shall be kept up to date throughout continuous professional development programs for all directors. In terms of internal control, basically directors are responsible to set up and maintain an effective system of internal controls, and this has to be assessed on an annual basis. They have to give particular consideration to existence of internal audit department, whether it exists or not. If not, then they have to reassess the need for it. Enterprise risk management, we already know how the company deals with risks and what's their policy in terms of risk identification and management. Corporate ethical culture, corporate social responsibility, whistleblowing facility that shall also be ensured by the directors. It has to be ensured by the independent board of the directors. That ensures a safe way of communicating or raising issues by the employees and the managers of the company. Communication with shareholders is also lies at the heart of good corporate governance, and also financial reporting. We all know what it is about. They have to present a balanced and understandable assessment of the company's past performance and present position of the company. This being said, now this is the end of our trainee videos on the ACCA F8 Audit and Assurance. I wish you good luck on your exams. Goodbye.